Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent action has, more or less, been captured within the two explosive days range back in late February between 1579 and 1759. Since then, despite an initial but now defunct bull channel, the market edged lower in a 2 steps up and 3 steps down action, such that at the start of April, we saw a test and breach of the support band 1579 to 1571, and prices briefly tested down to 1560. Now, this 2 steps up and 3 steps down action had left the door open for the late February to early April period to be a descending triangle pattern. A few things first before I go any further. This descending triangle is by no means a perfect example of such a pattern, but there are significant elements there that make the action look a viable opportunity. Next, we actually have two descending triangles, one inside another. The one from late February until the start of April, with the recent drop to 1560 being a false break lower, and the one from late February until mid-April, which includes the drop as part of the pattern. Finally, here a bit of information about descending triangles. Firstly, descending triangles can break in either direction, acting as a topping action as well as a continuation action. This one in question seemed to be a possible upward continuation pattern action. Indeed, in general, descending triangles that see a market rising beforehand, such as we've had, have something like a 6 or 7 times out of 10 chance of breaking higher. Hence, I placed some targets on the top side in recent weeks. An initial primary potential target X on the top side for the smaller descending triangle pattern in the 1757 area, right where the 50% projected Fibonacci resides. A fuller secondary target X1 would be in the 1810 area. If instead we take a look at the larger descending triangle pattern, here we would have an initial target X2 in the 1780 area, with a secondary target X3 in the 1844 area. These last two targets would tie in with something already spoken about back 8 weeks ago and repeated since. I spoke about 3 simultaneous patterns I'd seen over the middle and end of last year and going into this year. They are all bullish. They are a rounded bottom, large cup with handle pattern, and a scallop pattern. Now, the rounded bottom still has a primary topside target in 1983 area, which is off the top of my daily chart right now. The next one is the large cup with handle pattern, which has a primary target in the 1910 area. Once again, this is off the top of my daily chart. Finally, the scallop pattern, or to be accurate, the ascending scallop pattern. This has a primary target in the 1836 area, until recently off the top of my daily chart, and interestingly the one I have the least confidence in, even if it is the nearest. However, I rescaled my daily chart over this past month end, and you can see it labelled as target X with a question mark. These are all, as I've stressed repeatedly, way out there, but suddenly, as we've seen plenty in recent times, but suddenly lots of things that are way out there can happen to be true. All this is not unusual to anyone watching or listening to my commentaries. However, what we have seen over the last 3 weeks or so has not been a move higher, as such a break higher would indicate, nor have we seen the market treating the break higher as a false break and turning prices down sharply. What we have instead seen is a slightly lower but basically sideways action. Thus, this threatens all the descending triangles as patterns, and we may be forming something else completely. This requires some further study and market action to determine what and if this market is becoming. I would like to finish off once again on something I originally said in my annual review of soybeans made at the very start of 2022. Back then I was only looking at longer term charts, and I quote, "One other idea I would like to, let's say, provisionally float by you, is way early on this, but it should be worth considering, is to look at the whole of the 2020 to date action as a possible bullish halfway hesitation, in which case we might have, I say might, with due deference here, we might have a possible target X topside in the 20.25 area. I'll just repeat that, in the 20.25 area. This is way, way up off the top of my long-term chart, and it might sound ridiculous now. Indeed, it does sound ridiculous, but it is what I see. And I'd rather say it and maybe look ludicrous and even laughable now than be silent and be confirmed as an idiot who should have said something should it come about. Anyway, this is a multi-month target and likely a multi-year potential target X, so there ought to be plenty of time. Plus, it will all depend on what the market does when and if it meets the 2021 high at 1667 and the 2012 high at 1789. End of quote. This bigger picture idea, done at the start of 2022, is still there despite the recent daily actions. Chicago soybean meal. I said here 2 weeks ago that we have the potential for the late January to day action being one of two patterns. The first is a possible bullish halfway hesitation. The pattern, or the market, had some form on doing this, as it had constructed some bullish halfway hesitations on their way up, most recently in the mid-October 2021 to early February 2022 move. This led me to place a provisional target X1 in the 520 area just off the top of my daily chart, just in case this turns out to be true. The second possibility is to look at the same action as a topping action in some form. I was at the time not certain in what form this would manifest itself, and to be honest, I was not wholly sold of the idea, but I thought it worth mentioning. You see, I saw the possibility for a double or triple top, but I doubt as to whether it would have a head and shoulders top, as the neckline back then would have needed to be a French curve to be one. However, since then, the French curve has straightened itself out, and we now have a not perfect but workmanlike head and shoulders top. Tuesday last week, the market breached and closed below the neckline, currently at 444.70. Then last week, we had consecutive closes below it, and below the next support, the rising medium moving average, currently at 436.60. Prices are now pressing down on the 38.2% Fibonacci line of the October 2021 to March 2022 move at 422 even, with the 38.2% Fibonacci line of the whole of the 2021 to March 2022 move at 413.30 next on the list. All this bearish pressure is being helped by the overhang of the head and shoulders top, such that key 50% Fibonacci lines at 400.50, 389.10 and the slowly rising long moving average are now in the frame. Hence, I will retire targets X and X2 overhead after this commentary, and instead look at the primary target X2 for the head and shoulders top in the 416.5 area, and target X3 in the 390.5 area as the downside potential for now, the full downside potential for now. Only a pullback up and consecutive closes over the short medium moving average, currently 456.60, would effectively counter such a move. As a guide, we may have already reached, well, we've already almost reached the primary target X2. Chicago soybean oil. Of all the Chicago soybean complex, the landscape of the Chicago soybean oil and daily chart has changed by far the most. Initially, after the change gap in March, the market worked its way higher, filling in the change gap. However, the previous all-time high back in 2008 at 72.67 managed to temper, if not halt, the rise. On a 2 consecutive closing basis, though, until nearly mid-April. Indeed, the June 2008 high at 68.97, another relic from those days, stopped the subsequent fall. Thus, it was those 2008 levels that captured the recent market until 3 Fridays ago, when the market punched up through the 2008 based overhead resistance and up to test the levels seen back in early March and even higher. Okay, so last time I put forward some pattern options this market may have. They were for the late February to date action being a possible head and shoulders top, if looking on the continuous chart. Then again, the late February to date action being a possible double top, or what was, and continues to be my favorite, the mid-December 2021 to date action being a very large bullish halfway hesitation. The reason for my favoring this last idea was something I pointed out a few times before. It is the lagging indicator of three golden crosses over February and March that produced much of an impetus, enough of an impetus, that this bullish halfway hesitation pattern idea has seemingly taken hold, such that last week prices broke higher, making new all-time highs. However, last Friday's excessive move higher turned out to be a bearish engulfing pattern, if only just, right at the top of the recent market. We have this week seen prices fall, yet interestingly, this fall has been seemingly limited by the combination of the 50% projected Fibonacci line at 81.23 and of all things the short moving average currently at 79.90. If this 50% Fibonacci line, maybe even the short moving average support are maintained, then the opportunities on the downside may still be there. Thus, if we look ahead and above, we have a possible target X for this large bullish halfway hesitation pattern in the 92.90 area. I know it's a hell of an ask, but I feel obliged to suggest it. Plus, just beyond, we have the 100% projected Fibonacci line at 94.95. Now, the only obstacle ahead, bar what we've already seen, which I can suggest, is the big GAN number at 90 even. Now, looking below, the next significant support below the 50% projected Fibonacci line is the important 50% Fibonacci line for the whole of April at 75.24. One final point. The action this week has set up a possible 3-day pattern of a type of bullish morning doji star pattern. This pattern is not perfect and quite lopsided to the right, but it is there and may well influence what we have coming next. So watch out. One final point. I know I've gone on quite a bit already, but it is the last piece, I promise. We had a monthly key reversal up in bean oil last month. This is part of a longer term pattern, but it is very, very noteworthy. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.